In the shadowy depths of cryptocurrency markets, a silent game unfolds where vast fortunes shift hands not through luck, but through calculated precision. Most retail investors enter this arena believing that price surges stem from groundbreaking news or viral hype. They chase rallies, convinced that momentum alone will carry them to profits. Yet, this misconception blinds them to the orchestrated maneuvers of smart money institutions and large holders who dictate the rhythm of the market. These players do not react to events. They anticipate and engineer them, leaving the average trader trapped in cycles of false hope and despair. To understand this, we must first examine the foundational structure of crypto markets. At their core, these markets operate on blockchain technology, where transactions are recorded transparently, yet pseudonymously, allowing large entities to move funds with relative anonymity. Exchanges serve as the battlegrounds, with order books revealing bids and asks that smart money manipulates to their advantage. They accumulate assets during periods of low interest, when prices languish in consolidation phases. Picture a market in markdown. Prices fall steadily as fear grips retail participants, prompting them to sell at losses. Smart money steps in quietly, absorbing supply through over-the-counter deals or decentralized exchanges to avoid tipping their hand. This accumulation builds their positions without inflating prices prematurely. Once holdings are secured, the markup phase begins. Here, they engineer upward momentum, often by placing strategic buy orders that create the illusion of organic demand. Volume spikes subtly at first, drawing in early retail interest. As prices climb, psychological triggers activate fear of missing out, or FOMO, compels more buyers to pile in. Smart money amplifies this through coordinated actions, perhaps via automated bots or affiliated influencers who spread narratives without direct endorsement. The peak arrives in distribution. Prices hover at highs, luring maximum retail participation. Large holders unload portions of their stash into this frenzy, often masking sells with layered orders that maintain upward pressure temporarily. Retail, seeing endless upside, buys at the top, only to watch the inevitable reversal. The markdown follows as smart money exits fully, allowing prices to cascade downward. This traps the late entrants in underwater positions, fueling panic sells that further depress values. Throughout these cycles, market behavior reveals patterns rooted in human psychology. Greed propels the markup, while fear accelerates the markdown. Smart money exploits this asymmetry, knowing that retail traders often lack the capital or discipline to weather volatility. Blockchain analytics can expose some of these moves. Unusually large wallet transfers or exchange inflow signal impending shifts. Yet, even with tools like on-chain data, the average participant struggles against the information edge of professionals. Consider the role of liquidity. In thin markets, smart money provides it selectively, creating traps like fakeouts where prices briefly break resistance only to reverse. This shakes out weak hands, allowing accumulation at better levels. Exchanges' centralized nature amplifies this, as they control order matching and can influence slippage during high volatility. Decentralized alternatives offer some respite, but even there, whales dominate pools and governance. A common mistake is ignoring volume profiles. Genuine breakouts come with sustained high volume, whereas manipulated pumps show spikes, followed by rapid fades. Retail often confuses correlation with causation, attributing rises to external news when smart money has already positioned ahead. Reality checks remind us that no market is truly efficient in crypto's nascent stage. Regulations lag, enabling tactics that would be illegal in traditional finance. Contrarian observation: what appears as a bull trap might be the prelude to a real rally, but discerning requires patience. Smart money rarely broadcasts intentions. They thrive on misdirection. To navigate this, watch for divergence in indicators. Rising prices on falling volume often precede dumps. Avoid chasing extended moves. Instead, seek entries during quiet accumulation zones. Recognize red flags like sudden, unexplained pumps in low liquidity assets. Monitor on-chain metrics. Spikes in exchange deposits from large wallets signal potential sells. Cultivate emotional discipline. Set predefined exit strategies to sidestep psychological traps. Remember, smart money's edge lies in time horizon. They plan quarters ahead while retail reacts daily. In conclusion, understanding these dynamics empowers you to move beyond the traps set for the uninformed. By observing patterns and prioritizing education over speculation, one can approach cryptocurrency markets with the calm assurance of a seasoned participant. The game persists, but knowledge levels the field. If this explanation helped, subscribe for more clear breakdowns like this. Thanks for watching.